Okay, so we are at learning objective 4, which tells us about what the break-even point is. And break-even point is where your total revenue and total expenses meet at 0. That's your break-even point. Okay. And of course, we can do break-even analysis in a few ways um, as a mathematical equation. We can also use contribution margin, believe it or not. Or without getting too graphic, we can do a graph. Okay. Um, Break-even analysis is often expressed in the number of units we have to sell or the number of dollars, etc. But you will see that play out. So again, break-even occurs when total sales and total costs, both your variable and fixed costs, equal 0. So let's take a look at the very first line here. $500 times Q, right? Q is going to be what is the volume or the quantity here, minus, that's your required sales, minus 300 times Q, minus 200,000 in fixed costs gives you 0. Right, so first thing we need to do, right, is get all the Q's on the left and the regular numbers on the right. So we are going to add 200,000 to both sides, which moves the 200,000 here, and we can simply since the variable is equal, we can simply subtract them out, and so we have 200Q equals $200,000. And now that you know that, you can isolate the Q, although I don't like to isolate Q's because I like Q. Okay, never mind. So Q would be left alone here on the left. Boo-hoo. 200,000 divided by 200 would give you 1,000 units. That's the quantity, right, that we would have to sell in order to break even, in order for net income to be 0. So at the break-even point, in essence, whatever the contribution margin is, it's going to be equal to the fixed costs. That's how we get to 0. And remember, contribution margin is your total revenue minus your variable costs. So if your contribution margin equals your fixed costs, your income will be 0. That's basically the formula. Give me the formula, crabs. So what we got here is a contribution margin, looking at it in terms of units, break even in terms of units. So in this case, what we do is we take the total fixed costs that we have, divide that by the contribution margin per unit, which we'll know. And that'll give us a calculation of how many units we have to produce to break even. So this is another very important illustration that you'll need to know. The contribution margin ratio can also be used, okay? But in this case, it's going to tell us how much our break-even point is going to be in terms of sales dollars, okay? So here we have fixed costs of $200,000, and we divide that by the contribution margin ratio of 40% from our previous example, right? That would mean the break-even point in terms of sales dollars would have to be 500,000 in order for us to have 0 net income. Sales would have to be 500,000. Okay, and this is way too graphic. I don't know if you need a parental note to see this, because it is quite graphic. But this is how it would look in a graph. Of course, the break-even point would be expressed either in terms of dollars in sales, or in units of sales. But either way, as you can see, whether it's 1,000 units to break even or 500,000, again, it's in thousands, 500,000 in sales, you would break even at this point. Anything above that, clearly, you're going to be making some profits. Anything below that, both in terms of units and sales, you're going to be losing money, right? No loss. So I'll just go right to the do it exercise here, since it's already explained to you as well in your book on page 199. You have Lombardi Company, and they have a unit selling price of $400. They have a variable cost per unit of $240. So you know the sales price, you know the variable costs, you can figure out your contribution margin there, right? And they have fixed costs of 180,000. So they want you to compute the break-even point in units. First, using the mathematical equation. Secondly, using a contribution margin. So the first thing we're going to look at is the math. So you have $400 times Q minus $240 times Q minus fixed costs of 180,000 to get us to a break-even point of zero profit, zero loss. So when you go ahead and combine your Qs, you got 160 times Q. That's going to equal 180,000. Should be equal, right? Because you're going to. So there's something wrong with the slide here, but nonetheless, that means that when you divide it, you'll need to produce 1,125 units. Again, units. In order to break even. That's using this mathematical equation of isolating Q, even though it's hard to isolate Q. Like I said, I like Q, in order to get the units. The other way to do it is to use the contribution margin. You know the contribution margin is 400 minus 240. That gives you a difference of 160 divided back over 400. There's your contribution margin per unit. You have fixed costs of 180,000, contribution margin. I'm sorry, you got a contribution margin of $160 per unit. Sorry, not a percentage, just dollars per unit. That means that you'd have to produce 1,125 units, the exact same. So my bad, I looked at that as percentage ratio, but it's actually just per unit. So my bad. But that's what that one's about. How we do? Any questions on